The McAlvany Weekly Commentary, covering monetary, economic, and geopolitical news events. Now here are Kevin Orrick and David McAlvany.
It's a scandal. It's an elite. It's a group of crooked people. They're worse than the mafia. The mafia takes a certain personal risk by maintaining their territory. But the government and these elites are the worst kind of scum. And I think the American people should realize that. Now, the politicians will, of course, say, oh, the bailout is necessary for the ordinary people and so forth. But that is not true. The ordinary people will not benefit an inch by the bailout. That I guarantee you. The beneficiaries will be Wall Street and the politicians that are paid by Wall Street.
That was the voice of Dr. Marc Faber, managing director of Marc Faber Limited, who just recently said that this bailout's going to cost more than $5 trillion. Welcome to the McAlvany Weekly Commentary. I'm Kevin Orrick, and David, you're up in Seattle right now. Tell us what you're doing.
Well, the journey started in Los Angeles, went to Alaska, here in Seattle, and we end this particular journey with a conference, a one-day seminar in Vancouver, British Columbia. A group from Switzerland has asked us to talk on investing internationally, and specifically on our Swiss gold storage program, which has been most popular here coming into this election period.
Well, David, this has probably been one of the most tumultuous weeks so far since we've been talking.
The public really only takes note of a financial crisis when it affects them directly. My home is losing value. My investment and retirement account is going down. Then people take note of what's been in the making for months or years. The solution sought is frequently as simple as the public's attention span is short. Bail me out and get the bad guys that did this to me. In the last 10 days, the death toll has risen to include Washington Mutual, Glitner Bank in Iceland, Fortis in Belgium, Dexia in France, Bradford and Bingley in England, Wachovia here in the United States. These firms have either been bought for pennies on the dollar, taken over by regulators, or gone bankrupt. The losses associated with this week's carnage run into the hundreds of billions. Stock market losses this week have been over $1.2 trillion, which does not include the cost of the bailout in whatever form that ultimately takes. Added to the decline tallied thus far this year, we now stand at $4.5 trillion in stock market losses.
Well, that's right, David. Today we're joined by Dr. Marc Faber, today talking to us from Thailand. Dr. Faber's historical and economic insights are invaluable, as you know. As a thinker, we really respect him greatly. And as a financial market practitioner, his experience and success, they speak for themselves. We want to encourage our listeners after this program to explore his website to get to know him further at gloomboomdoom.com. That's spelled GLOOMBOOMDOOM.com. And by all means, subscribe to his market commentary. You will not be disappointed. Dr. Faber, there are dozens of things we'd like to discuss with you today, but for the sake of time, let me just give you a few topics we definitely don't want to miss. Of course, this bailout that's being discussed in Washington and bantered back and forth, the effect that will have short-term and long-term for the U.S. dollar. Of course, we want to also know how that would affect gold, short-term and long-term. The equities market, as we know, just this week it's been extraordinarily volatile. And, of course, how does it spell for inflation? Now, I'll start my question in going back to the bailout. Yesterday, $630 billion was added in liquidity, just in the form of swapping toxic paper for treasuries. So we're already seeing infusions almost the size of the bailout that Washington is looking at right now. Is $700 billion enough?
Well, first of all, thank you very much for having me on your program. And also, I don't have all the answers to your questions. But basically, the bailout macroeconomically will change very little. I think that, first of all, the bailout of even $700 billion or even $1 trillion is a drop in a bucket compared to the total credit market, which in the U.S. is now over $50 trillion, and compared to all the unfunded pension fund liabilities. But it may help to postpone the calamity and boost temporary equity prices. I'd also like to mention that equity prices have been going down worldwide. We had a bear market in equities, and in the world they're down between 25 and say 50% since last October. And usually markets bottom out between end of September and the beginning of November. So the market could actually rally into next March by, I would imagine, in the U.S. 10 to 15%, and in emerging economies by about 20%. But I think that to focus on the bailout package is wrong, because in the context of everything, the bailout package has very little to do. What is important to understand is that the period 2001 to 2007 was characterized by a global synchronized boom. If you traveled a year ago around the world, everywhere you went, there was boom conditions, heavy construction, capital spending, rapid credit growth, and so forth and so on. Whether you went from Dubai to Europe, the U.S., to Latin America, Australia, Asia, everywhere there was boom conditions. And equally, and this you have to give credit to Mr. Bernanke and Mr. Greenspan, we had bubbles in every asset class. In the 19th century, even under a gold standard, we had occasionally bubbles in, say, real estate or railroad stocks or canal shares and so forth. But the bubble in one sector of the economy was accompanied by deflation somewhere else, because money supply was kept relatively constant. Or you take the 70s, we had a commodities bubble, but bonds collapsed. Or you take the 80s, we had a huge bubble in Japan, but commodities collapsed. And so normally, under normal conditions, when something goes up, something else goes down. But Mr. Bernanke and Mr. Greenspan, through their ultra-expansionary monetary policies, drove all asset prices up and created illusionary wealth. I'd like to point this out, illusionary wealth, because at the same time also prices increased, and the average U.S. household did not benefit greatly from the boom, to some extent because their home prices went up and they refinanced. But now that home prices are down, they pay the price for this illusionary wealth. Now, in this environment of all asset prices having gone up, commodities, stocks, real estate, art prices, any kind of worthless collectible, I suppose that combined with the global boom that took place everywhere, eventually we will have a global bust in just about every asset class and also in the economies of the world. And that this global bust will then lead to very disappointing corporate profits. In particular, corporate profits in the financial sector will for years and years not reach the peak levels we had at the beginning of 2007. So the valuations of equities are not particularly attractive at this point. At the same time, as you know, Mr. Bernanke and Mr. Paulson are building up huge liquidity injections and fiscal deficits by taking over essentially assets, and that in the long run will have, of course, inflationary implications. Inflationary in the sense that the purchasing power of money will lose. And in this scenario, you have to ask yourself, the purchasing power of money will lose against what, in my opinion, the other countries in the world are to some extent even in a worse shape than the U.S. And therefore, when purchasing power of money loses out, it has to be against precious metals, in particular gold.
Well, as we look at double-digit inflation for 3 billion people, you certainly have an awareness of gold on that basis, people looking at it as an asset or an inflation hedge. We're most curious, at what point does the liquefaction, the treasury auction facilities, the repos, et cetera, what point does the liquefaction of the system begin to have an overtly inflationary impact?
Well, let's put it this way. I think Mr. Bernanke has no clue about economics, because for him, inflation is core inflation, which even excludes food prices and energy. For me, inflation is money supply growth and credit growth. And that the Fed under Mr. Greenspan and Mr. Bernanke totally overlooked. That's why we had this huge asset bubble, first in NASDAQ stocks in the year 2000, and then when NASDAQ stocks started to fall in March 2000, the Fed cut down the Fed fund rate